Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in company filings. Today we're diving into Harrow Inc.'s latest report. And let me tell you, it's got some interesting moves, including a big debt reshuffle. So Harrow Inc. is a company that's making some significant financial decisions. They've just announced a whole lot of activity around their debt, specifically issuing new notes and redeeming old ones. Think of it like refinancing your house, but for a big corporation and with a lot more complexity. The meat of this report really kicks off with information about a major deal, a purchase agreement. Harrow entered into this agreement back in September 2025. This agreement is all about selling new debt, specifically 8.625% senior notes that are due in 2030, or perhaps their credit isn't as strong as they'd like. This purchase agreement itself contains all the usual stuff for a deal like this. You have representations and warranties. Basically, Harrow is saying this is all true and accurate about their business, and covenants which are promises about what they will or won't do. They also agreed to protect the people who are lending them the money, the initial purchases from certain issues. This is all pretty standard boilerplate, but it underscores that this is a significant financial transaction. Now let's talk about the notes themselves. These are senior unsecured notes. Senior means that if Harrow gets into trouble, the people holding these notes get paid back before some other debt holders. Unsecured means there's no specific company asset tied directly to these notes. If things go really bad, the lenders might not get all their money back. They're set to mature in September of 2030, meaning that's when the principal amount is due to be paid back. Interest payments are happening twice a year in March and September. Here's where it gets interesting. Harrow can actually pay back these notes early before their 2030 due date. But there's a catch. If they pay them back before September 2027, they have to pay an extra amount, make-whole premium. It's like paying a penalty for paying off your loan early, but in this case, it's to compensate the lenders for not getting the full interest payments they expected. They can also call back a portion of the notes up to 40% early using money from selling stock. This gives them flexibility if interest rates change or if they get a good deal from selling shares. And listen to this, if a significant event happens, like a change in ownership that triggers something specific, Harrow might have to buy back these notes from the holders at a higher price. This adds another layer of protection for the note holders, ensuring they aren't stuck with debt if the company's fundamental situation changes drastically. So these new notes are essentially Harrow's promise across the board. They rank equally with past and future senior debt. This also means they're in a weaker position than any debt Harrow might secure with specific assets. What's more, these notes are guaranteed by Harrow subsidiaries. These are the company's own businesses that it owns and controls. So if Harrow itself can't pay, these subsidiary guarantees are supposed to help. However, they're still structurally subordinated to debt from subsidiaries that don't provide these guarantees. It's a complex web of who owes what to whom. The agreement also has covenants, which are rules Harrow has to follow. These rules limit how much more debt the company can take on, how it can pay out money to shareholders. Things like dividends, and even restrict selling off parts of the business. These rules are pretty standard, but there's a cool escape clause. If two of the major credit rating agencies like Moody's or S&P give Harrow an investment grade rating, meaning they think the company is a safe bet, many of these restrictive covenants go away. That would give Harrow a lot more freedom to operate. And of course there are causes for what happens if things go wrong, the events of default. These include not paying money back on time, breaking the rules in the agreement, or if the company or its key subsidiaries face bankruptcy. If any of these happen, the lenders can demand their money back immediately, plus any interest owed. It's also worth noting that the banks and firms involved in selling these notes might also be doing other business with Harrow. This is pretty common. They might be advising them on other deals or providing other financial services. It's a way for these financial institutions to make money from multiple angles. This section just confirms that the previous discussion about the new debt is indeed a new financial obligation for Harrow. It's pretty much a cross-reference to the earlier details. But the story doesn't end there. On September 12, 2025, Harrow also completed the sale of these 2030 notes. This was a private offering, meaning they didn't sell these to just anyone on the street. They sold them to qualified institutional buyers in the US and some international investors. This kind of private sale is often faster and less regulated than selling to the general public. Out of the $250 million they aimed to borrow, Harrow actually pocketed about $244 million after all the fees and discounts. That's a pretty typical amount to lose to fees in a deal like this. So what are they doing with this cash? They plan to use it to pay down other debts, specifically mentioning their credit agreement and their existing 2026 and 2027 toonies. It's a financial housekeeping move, cleaning up the balance sheet. Now, here's the really significant part of this other events section. On the very same day they issued the new notes, September 12, 2025, Harrow also delivered a notice to redeem all of their outstanding 8.625% senior notes that were due in 2026. These are the so-called 2026 notes. This means they're paying off that older debt early, using some of the money from the new 2030 notes. These 2026 notes were traded on the Nasdaq under the symbol Harrow. Just like with the new notes, paying off the old ones early comes with a cost. Harrow will pay back the full face value, plus any interest that's already accumulated and unpaid. And here again, a make-whole amount. This extra cost is to compensate the 2026 note holders for not getting the rest of the interest they were originally promised. So Harrow is essentially swapping out one debt for another, a common strategy in finance to get better terms or manage cash flow. The company also included a standard legal disclaimer, basically saying this report isn't an advertisement to sell or buy their stock. It's just reporting on what they've done. And like most companies these days, Harrow has a section on forward-looking statements. This is a legal shield they use. They're talking about what they expect to happen in the future, like using the money from the new notes and paying off the old ones, but they're warning everyone that a lot of things could change and their actual results might be very different. They're saying don't rely too heavily on what we're saying about the future because risks and unknowns are everywhere. It's a smart move to protect themselves from lawsuits if their plans don't work out. Finally, we get to the exhibits. This is where they provide the actual legal documents, the purchase agreement for the new notes and the indenture, which is the formal contract for the debt. They also include what the new notes will look like. These are the official papers that back up everything they've discussed. It's like the blueprint of the deal. And the whole report is signed off by Andrew R. Boll, who's listed as President and Chief Financial Officer. This is the person officially making these announcements on behalf of Harrow Inc. So what's the big picture here? Harrow Inc. is actively managing its debt. They're issuing new, longer-term debt at a pretty high interest rate of 8.625% and using that money to pay off older, shorter-term debt. This suggests a few things. They might be trying to lock in their borrowing costs for a longer period, especially if they expect interest rates to rise. Or they might be finding that their existing 2026 notes will be becoming too expensive due to their maturity date, are proactive in managing their financial obligations, but the relatively high rates could signal potential concerns about their cost of capital or future growth prospects. If they're using that money to pay off structure, they're really putting their chips on a strategy that will pay off these shorter-term obligations and manage their interest expenses. The make-whole payments for redeeming the old debt early indicate they are willing to pay a premium to gain more financial flexibility for the future. It's a move that shows they are proactive in managing their financial obligations, but the relatively high rates could signal potential concerns about their cost of capital or future growth prospects if they are borrowing at these levels. We'll have to keep an eye on how these new notes. What's your take on Harrow's debt management strategy? Does this move signal strength or potential future challenges? Let me know your thoughts in the comments section below. If you found this breakdown helpful in understanding Harrow's financial moves, please give this video a thumbs up and make sure you subscribe for more in-depth corporate analyses. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next one.